Hey, let's begin. Good morning, guys. My name is Gavin. Welcome to Alphachain's weekly market analysis. Looking at the date, it is the 22nd of November. It's Tuesday. This coming up to 10 a.m. Bring this chart over on this side here. So you can quite clearly see that the UK markets have opened in a positive direction. So it is up. It's moving to the upside. It's almost testing the 7,460 figure. Now, just reviewing, why is that the case? I think this is largely due to the follow-on knock-on impact from the oil markets. So we saw rising prices in Brent and crude oil, and that supported the FTSE 100 this morning at the open, despite overnight in the Asian session, we saw a lot of the markets move to the downside. Yesterday's session also peaked a little bit, and then moved towards the sort of downside also. And that was largely due to sort of Asia-related news. Yeah. So the markets are still fragile, shall we say, with all the COVID-related developments that are coming out from China. It seems that China has done a major U-turn on its reopening plans. Beijing posted a record number of new COVID cases yesterday and today, well, overnight today, with the Chinese capital really started to tighten and apply further restrictions. So they've sent their schools back online, they've closed many of their restaurants, and they've forced employees to work from home. There had been 28,000 new infections reported nationwide. And if you think about where that is in regards to history previously, that is nearing the record high since the pandemic actually began in 2020. Okay, so, that is quite negative, right? And why is that negative in the oil market? So what we saw in the oil markets yesterday was a bit of a yo-yo. Are we oil markets being here, right? So this is what we saw. If I just to a full screen here, so you can quite, okay, so the 1 hour time frame. So we saw the markets trending lower as we started to see that COVID cases were getting out of control in Asia Pacific, in China particularly. And that brought down oil prices because there's going to be less demand for oil. And then yesterday we heard that there's a large number of cases and, they are doing a U-turn on their restrictions that caused for trouble in the oil markets falling even further. But there was some added noise to this as well, which was Saudi Arabia. So it was reported yesterday morning, but I don't remember which media outlet, but it was reported that there were that the Saudis were looking to increase the production levels. So there was word of that they were going to increase their barrels by 500,000 per day. Right, and that's a large amount because they took a substantial amount offline, so they've reduced the production level, but all of a sudden they're doing a U-turn and increase the production. So you've got now COVID cases rising in China and the demand for oil weaken. And then at the same time, you then have Saudi and OPEC plus groups likely to increase their production. And there was hope that maybe the G20 summit where Joe Biden and MSB had met and spoke, and they seemed like they were on better terms, they may have U-turned because of their, improved relationship, shall we say. But it was very quickly just noise. It wasn't approved, right? So the official Saudi press agency said Monday night, and that's where we saw the U-turn begin, that, just have a look at my notes here, that they basically denied it. Okay, so categorically denied that they were going to have an increase in production. They're going to maintain what they previously suggested, which was, they've taken a certain percentage off. They're going to maintain that through the end of 2022 and even likely towards the end of 2023. So based on that news, we quickly saw the oil prices firm, right? A bid taking place in the oil prices, and that's where we are now. So hitting those lows around the 75, 90, so 76 figure, should we say, has been the round number, and then bouncing off that level back around the 81 50 mark, should we say, hitting a high of 81.50, and it's just balanced at that point there. So a U-turn sort of in the oil markets there quite quickly. Following on from that, you know, it does seem, if I just look at overall momentum, and we're just looking at coming back to, hang on, let's reduce this. Looking at, say, the US markets, okay? So if we look at the NASDAQ and the S&P 500, and we'll just focus on the S&P 500 at the moment, and I'll go to a bigger picture view, right? So, and this is what we're seeing at this moment here, right? So this is the overall trend direction that we're seeing. So we've got strong downtrends taking place. We're in a bear market, or some time now, since the beginning of this year, shall we say. Yeah, we've been in a bear market. So it's a prolonged down market. Yeah. So lower lows and lower highs being formed all the way through. Most recently, from the low of mid-October or early October, we started to see a bull rally taking place, getting to from a low of, say, 3,500, testing a high of 4,000. Okay, so tested a 4,000 figure. So a 500 points of move there. Since then, it's been mostly moving sideways or starting to sort of trickle down, maybe, moving slightly lower. So it seems that that original momentum that we had seen, and this is largely due to the most recent 2 or 3 inflation reports coming in slightly better. The most recent one was much better, but prior to that was slightly better than hoped. So we're starting to see how inflation is starting to creep lower. That means that there might be not a Fed pivot, but a Fed slowdown in regards to raising interest rates. But that's not the case, and that's I'll touch on that in a minute or so. But yeah, so the hope had been that, okay, that's going to cause the next rally to take place, but it just seems that that momentum that we've seen previously on these days, in these certain sort of sessions that we've seen, look at the candle formation, the large candle formations. We've lost some of that. It's starting to really begin to fade now. And we're just waiting to see what is that big next catalyst, or next big catalyst, right? So what is that next big catalyst that's going to come through and that's going to drive markets either higher or lower? And that's what we're waiting for, is waiting for that new information to really step in. This week we do have the Fed minutes, so keep an eye on that midweek, right? So we're going to have the Fed minutes that will, provide maybe some volatility, maybe not so much market direction. Remember, the Fed minutes is telling us what's taken place in the previous meeting, right? So most of it should be already known in the markets, but we're going to get a bit more detailed scripture from the Fed policymakers. So that will just cause a little bit of volatility, but a lot of it might subside. I mean, we're going to head into the Thanksgiving holiday in the US as well. So there'll be some volume that's offline off the market. Looking at today, we have the Eurozone consumer confidence. So that's something that you need to be mindful of. But then, we're going to kick off another round of global PMIs. Okay, that begins tonight with Australia, into tomorrow with the rest of the nations there. So yeah, I mean, that's where we are at the moment. We're in that balance. We're in that zone. We're waiting for fresh catalysts to come in and really give us direction, market direction of where we're likely to go. Yeah. So we spoke about FTSE 100, we spoke about the oil markets, we spoke about the S&P 500 and where we are at this current moment in regards to, a fade potentially taking place. Looking through to, let me just bring this up. Let's look at the dollar, the US dollar. So if I just do a full screen there, maybe move to a slightly higher time frame. Okay, so the US dollar, somehow managed to, dig deep and stop its most recent drop that we've seen. Yeah? So Fed members, and that's largely down to Fed members. So the speeches that we're hearing from Fed members. I've got this great little screenshot that I'm going to share with you guys in a moment or so, but that's going to give us a good idea of where central banks are in their policy stance, right? And that's still, that's a cheat sheet, shall we say. But yeah, Fed members, we've heard from Lyle Brainard. She's, vice chair, shall we say, to Jay Powell. Now she's come out quite hawkish, and the most recent rhetoric has been hawkish. So even though we've had a positive CPI, print, meaning that CPI has fallen and has been regarded as a positive step in regards to the inflation controls and what the central bank is looking to do in regards to their mandate of bringing down inflation. And then the view is that, okay, then the Fed policymakers may begin to switch up their language, their rhetoric, which has not been the case. They've still continued to remain hawkish and saying that it could be just seen as a blip at this moment. It was just too early to really regard as that, this is the peak inflation, and that they're going to continue with their hawkish view, their hawkish rhetoric, as we've seen. And that's allowed a bit of dollar strength come through at this moment, right? But again, we need to continue to see what takes place in regards to the central bankers and what they share and the upcoming meetings. As I said, the meeting minutes that is coming out midweek tomorrow is not going to be highly regarded. It's going to cause a bit of volatility. I doubt it's going to give a new market direction. We'll have to wait and see to the December rate decision. Yeah. Coming over to the euro. Now, I'm not going to talk about the dollar side. We just spoke about the dollar side, but the euro itself, it's been relatively quiet, quite weak, as we're going to see EC members begin to indicate that hikes will continue. So that's what we're hearing, is that EC members are likely to continue with their rate hiking, but the peak is probably not as high as markets expected. Okay, so we don't see that the ECB are likely to raise rates at such an aggressive manner and for a prolonged period. There might be a few rate hikes as we've seen previously. They might continue with the same hike, but it might stop at some point, and that's it. They will maintain that level for some time. Okay, so again, the euro has crossed back above parity levels. So once it was below parity. So let's have a quick look. So it tested the parity level, shall we say, the 14th of July. Okay, so test that parity level, 14th of July. Rebounded quickly. Okay, so it pierced through, rebounded to test around the 103.50 handle. From that point, it then went on to sell off through the parity level, closed through that level as well, held that level for some time, and it just ranged in that zone, a bit of a pullback, and then eventually it sold off on more catalysts from the ECB, right? And then it got to a low of, shall we say, close enough to spot 95, well, it broke through 95.50 handle, so 95.40, should we say. From that point, it rebounded back up to test the parity level again, and then it tested and broke through and closed above that level once again. And then now we're here, right? So it's back to sort of that resistance level here. So I wouldn't say we're out of the bottom yet, okay? That's not the case at this current moment. If you're following your technicals, yes, we have a series of higher highs and higher lows, but a pivotal resistance is this region here, right? So you've got these two levels of support and the most recent resistance before we broke through the parity and closed at that parity, below the parity level. So I'd want to see a follow through. Yeah, so I want to see a new high being formed, and then I can say, okay, potentially now we might be trending to the upside. A lot of the moves that we've seen in the euro is largely related to the dollar side. So that's one thing to note there, is that when we see dollar weakness, that's why we've seen a bit of strength coming in the euro. But if we now see that the rate hike continue as normal from the ECB members, then they could be a little bit trickier there, right? So yeah, so just be mindful of that as well. So coming over to the pound, looking at the pound. Okay, I mean, what can I say? The new PM and his new, cabinet member team have stabilized the markets, right? So since then, okay, there's a few things that's happened. One, we had the Bank of England raise rates and at the same time gave us a very bleak view of market conditions and suggesting, well, not suggesting, stating that we're in a recession and the recession is likely to be prolonged and such, right? So a very bleak view from the central bankers. At the same time, we've had a new PM be, instated at this, and then he's brought in Jeremy Hunt, who's managing, he's the Chancellor of Exchequer, who's now working on a new budget. That budget came out on the 17th of November. And that budget, there were some big changes. There are certainly some big changes. And it wasn't similar to what we saw in the previous so-called mini budget, which led to the second largest stimulus package in history for the UK. It was the opposite. It was more tax, cuts are taking place. So for example, capital gains tax has been reduced or will be reduced from next year. For corporations, that's an example of that. So yes, there was certainly, more, more pulling on the purses rather than, you know, releasing the purse, right? So yeah, certainly we're going to see a little bit more uncertainty taking place, but the question came down to, are they likely to stabilize markets? And they have. It seems that they have, right? So most recently, we've seen Rishi Sunak go into the G20 summit. You know, he's looking to, you know, have better relationships even with, you know, OPEC members such as Saudis, right? So there was discussion of that. Yeah, so we'll have to wait and see of any other developments that come from this. But overall, the pound is moving to the upside on the stability that's come into place with the new PM and his cabinet members. Okay, so we can have a quick look at also gold. We'll have a look at gold as well. So gold, what's going on with the precious metal, should we say? So as we've seen weakness in the dollar, we saw a bit of strength come through in gold. At the same time, the scenario that's playing out as well, we've got to be mindful to that as well, right? So you know, without a doubt, most central bankers have warned of a recession, so that is clearly there. But a lot of it is priced in. So do note, you know, a lot of individuals that's suggesting that, yeah, we're going to a recession in 2023. You know, that's the great time to sell the markets. Well, no, because I truly view that a lot of it has already been priced in. So we're forward thinking, we're forward viewing, right? So the market has already anticipated a recession in the year ahead. Therefore, a lot of the price action and a lot of the pricing has already taken place. So when it actually is a recession, we might see a little bit of stability. We might even see a rally, right? So to come out of the recession, right? As you know, the central banks begin to loosen their stance in you know the tightening of liquidity and the monetary policies that they've set, right? So yeah, that's one thing to note there. But overall, precious metals, you know, it was you can still say the previous few weeks have been a very strong few weeks. It's just that we saw a bit of a pullback occurring towards the end of last week. The main risk for metals at the moment, or precious metals at the moment, is the hawkish Fed. Yep. So caution is advised there. If the Fed begin to continue with their rhetoric of hawkishness, then yes, that's going to have a knock-on impact in gold. Yeah. Okay, we could also have a quick look at cryptos as well, as we've had a new break of the low. So looking at BTC USD, just scrolling down to the 4-hour time frame, you know, did we break the low? Not about it, right? So is an equal test to a low, maybe it pierced through the prior low and then pulled back, but the trend is not looking great. The trend is still more to the downside. So there is still more correction taking place at this current moment. You know, the crypto markets are trying to find their footing at this moment, right? And it's following that substantial FTX debacle, this big issue that's caused. And what the market's waiting for, and the big question is there still that contagion effect, right? Is there contagion impact going to be taking place across the board? And there has been few rumors out there of what's taking place, but nothing has been substantiated at this current moment. Okay, so just be mindful of that contagion effect. You know, there was discussions of BlockFi at one moment, but yeah, I mean, you know, I think they have gone into liquidations at this moment, or they've filed bankruptcy. We'll still have to wait to hear from this. Confirmation of this, but what we're looking for is this the worst case of the scenario, right? You know, is FTX going down, and there's, you know, there may be a little bit of contagion effect, but I don't think, you know, that could be the going to be a larger move to the downside for that. So yes, where markets are moving to the low side, we're seeing a bit of a correction taking place, but at the same time, the markets, you know, are waiting for news. If there's no news that comes out, then I can see that there's more of an upside view. But if we see that contagion impact being impacted with a few other cryptocurrency firms out there, then certainly we could see a bit more of a downside move. So yeah, BTC USD is at 50,695. At the same time, ETH is also testing. What is it testing this kind of moment? 1,083 at this moment. Yeah. Just looking through my notes as well. Yeah, I think, you know, The markets are still mostly driven by the Fed. Just remember that. Okay, so the markets are still mostly driven by the Fed. And as such, every economic data release is going to be very important going forward into that Fed rate decision, right? So the question is, will continued data weakness be enough to cause Jay Powell to pivot or stabilize or maintain more balanced, neutral view? Or are the markets are hopeful that this will happen, but it's very possible that they will be disappointed in the short term as the markets continue to slide to the downside. Right? So, yeah, are there any charts that I want to also show you? I think I did mention a few things. So, over the weekend, we did hear from Disney. So, yesterday we heard from Disney in regards to we'll just switch this off. What's going on at the moment? Okay, so at this current moment, so on Sunday, the board members of Disney had ousted the CEO and put in their ex-CEO from 3 years ago back into that position as CEO, sort of, the commanding role, right? And that was actually seen as a positive thing on Monday's session in the markets, because we saw Disney go up by 6%. But if you want a bigger picture view of where, what it looks like, hang on, let me just bring this up for a moment. This group here. This is what it looks like at this moment, right? So we can see how the share price has been moving since 2000. Since 2000, Bob Iger first appointed CEO in 2005. Then he acquired Pixar, then Marvel, Lucasfilms, opens Shanghai Disney Resort. So all of this led to sort of the upside move that we've seen in the in its market valuation, the market cap. And then it went sideways for a little prolonged period, and then back to the upside. And that's when Bob Chapek, if that's correct, if that's how you pronounce his name, he was put into place, didn't fare so well. He was out, and now Iger's back in. Okay, so that was the only news that came through. And usually when there is a major change like this, they generally have a succession plan, right? You'll see that large corporations, especially like Disney, right, the biggest in the entertainment industry, right? You'd hear that, okay, there is, they will give the market, they'll let, their shareholders know what's taking place or have a view in this or whatever it might have been. But this was, kept on the hush. There was a board meeting on a Sunday that took place, and the change took instantly. So, yeah, that was sort of one of the news there. Something else to share with you. Talking about the World Cup, as some of you may have heard of, and looking at the amount that's being spent. Now, I'm not going to go through and talk about some of the debates that are going on at this current moment, right? That's not my forte. I don't want to give an opinion there at all. That's not, not my point here. My point here is the amount that was spent in the development of the for the World Cup, right? To host the World Cup, and they have exceeded what any other nation has done in the previous games that we've seen, okay, the previous World Cup games that we've seen. So, I mean, no one even really comes to it. I mean, Brazil, which hosted in 2014, they spent around 15 billion. Russia hosted in 2018, 12 billion was spent there. I mean, the US billion spent less than 1 billion. I think it was like 500 million that they spent. They've got a lot of the infrastructure already developed anyway, right? But Qatar have reportedly spent, what is confirmed, this is not, it may be more than this, right, is 220 billion on the World Cup itself. So a lot of money went into that development for 6 weeks, shall we say. Okay, something else that I can also share with you. How does Goldman Sachs make money? This is something that I've found online somewhere. So, you can see their net profits being around 21.6 billion. So that's the 36% margin on revenue, right? Tax they've paid, 20% tax rate as well. So 5.4 billion, that's through their, well, let's not go there anyway. And these are sort of the other operating expenses that they have. Yeah. Okay. Interest expense is at the bottom there. Again, not to focus on there, but look at the interest income that they're making. And then the net interest income. So that's net, that's interest income gross. 12.1 billion was made through there. Other principal transactions, around 11.7 billion. Market making, right? So this is a very strong area for Goldman Sachs, is market making. They made 15.4 billion there. Commission and fees, 3.6 billion. Investment management, 8.1 billion. And investment banking fees, 14.2 billion. So the vast majority of their income or revenue, shall I say, is coming through investment banking fees, market making, and also just interest income, right? Interest income. Yeah. Something else to So they've also reported, right? So this is coming from Goldman Sachs, that if you feel that the market's at the bottom now, it's going to move up to the upside and it's going to hit back to all-time highs again, that's far-fetched, right? Goldman Sachs have set a target for 2023 of around this price level. So they don't see that we're going to see a lot of change taking place in markets. Yes, there's going to be volatility. Certainly there will be volatility. But at this current moment, it just seems that the market's at the bottoms, it's at the lows. It's going to range around this region until there's a bit more optimism coming through and growth stepping in and productivity improving, right? At this current moment, markets are likely to stay around this region through the course of 2023, as reported by strategists from Goldman Sachs. And this is the cheat sheet that I've been highlighting, right? So now this is the central bank policy snapshot up until now, okay? So what have they done? What have they said? What do we expect? Okay, and this is breaking it down for the Fed, the ECB, the BOE, and the Bank of Japan. Okay, so with the Fed, what have they done so far? For federal funds rate is around between 3.75% to 4%. Federal Reserve has increased the federal funds rate target range by 375 basis points since the start of the year. So that's how much they've raised by 3.75%. Yeah, balance sheet shrinkage accelerated to its maximum rate of up to 60 billion in treasury securities per month being bought, right? So, so they're certainly sort of controlling the balance sheet, and up to 35 billion in agency MBS per month, right? Mortgage-backed securities, that is, mortgage-backed securities. So what have they said? Now, this is focusing on the rhetoric that we're hearing. So from Weller, it's hard to pause rate hikes until inflation moderates. Yeah. I don't see financial stability concerns slowing the Fed's rate hikes in this current moment. So again, that's a hawkish view. Kashkari, there are going to be some failures around the global economy. So given a bleak view there. But to me, the bar to actually shifting out our stance on policy is very high. It should not be up to the Federal Reserve or the American taxpayer to bail people out. So he's certainly calling that there's going to be a bit more risk out there as we're sort of trying to control inflation. Reinhard, we are attentive to financial vulnerabilities that could be exacerbated by the advent of additional adverse shocks. Monetary policy will need to be restrictive for some time to have confidence that inflation is moving back to target. For these reasons, we are committed to avoiding pulling back prematurely. We also recognize that risks may become more two-sided at some point. Okay, so all three hawkish views, right? One's a bit, more pessimistic than the others in regards to, the economy, but largely they are still very hawkish. And what is being expected at the moment? The Fed to deliver a 50 basis point rate hike in December, then thereafter 25-point hikes in February and March, and for a peak funds rate to achieve 4.75 to 5%. So that's the Fed's view there. I don't think we have time sort of to go through each and all. What I might do is I'll leave ECB and BOJ because I'll let you read that, but I'll cover Bank of England. So Bank of England base rate is currently at 3%. The BOE has increased their deposit rate by 2.9% since December last year. So they were the first central bank of the G7 nations to begin rate hiking first, right? The Bank of England conducted temporary and targeted purchases of long-dated UK government bonds from September 28th through to October 14th. I do note, I'm not sure if this is going to mention what took place with Liz Truss as well, right? Where they had to, help bail out some of these LDI funds. Okay, so Andrew Bailey So this is specifically from Andrew Bailey, this commentary, right? This is specifically from Christine Lagarde. So these are, the key views there. Okay, so the bank is monitoring developments in financial markets very closely in light of the significant repricing of financial assets. So, they're looking at market conditions, but they don't care so much about what asset prices are doing. Yes, asset prices might be falling, but not so much so if you look at the FTSE 100, to be fair. But at the same time, how much of that is having a knock-on impact in the general market? That's the view then, right? The Bank of England has had to intervene to deal with a threat to the stability of the financial system. So that was what I just spoke about, the LDI funds. There may appear to be a tension here between tightening monetary policy, as we must, including so-called quantitative tightening, and buying government debt to ease a critical threat to financial stability. Right? This explains why we have been clear that our interventions are strictly temporary. So they did that for a temporary period of time, and have been designed to do the minimum necessary to keep the market above, right? So to keep the market above water, should we say, right? So we're still expecting the Bank of England to deliver a 50 basis point hike in December, followed by a 50 basis point hike in February, and maybe then 25 basis point hikes in March and May for a rate to be in the region of 4.5%. Okay, so 3 to 4.5% there. Yeah, like as I say, a view there. I mean, this did miss out on some of the sort of pessimistic views that we heard from Andrew Bailey in regards to, a broader, prolonged recession could be taking place as well. But yeah, I mean, this is your current cheat sheet in regards to central banks, and that's going to be very important in the next few weeks. So you must be aware of this. You must read through this and, have this screenshot, available to you, especially given where we are at this current moment, where the focus is the central bankers, in my view, going forward. Okay, so the central bankers are going to come at the forefront when those central bank meetings take place early December, and that's where we could see the next direction in markets as well. Okay, I believe that covers it all. Well, I'll end the recording. Thank you for joining this session. If you have questions, I'm ready for those questions. So let me switch the recording off and we can get started.